Hey guys, it's Anthony. Welcome back to the channel. If you're new here, I personally trade ES NASDAQ futures. I do day trading and swing trading. If you trade S&P 500 or NASDAQ, you definitely want to hit that subscribe button. In this video, we're going to talk about where the market has gone this past week and where we think the market's going in the coming weeks. If you're working on becoming a consistently profitable trader, definitely hit that subscribe button. It's taken me 2 years to become consistently profitable. Lots of trial and error, lots of courses paid for, lots of losses taken, dark times. But if you stick with it, you'll come through and become consistently profitable as well over time. I fully believe it as long as you put in the hours. So without further ado, let's take a look at the charts. We're going to take a look at ES and NASDAQ. So S&P 500, NASDAQ, we're going to see where we think it's going in this coming 1, 2, 3 weeks. You'll see I've been in this swing short of an average of 41.50. Currently, stops are going to be above the high we made on the debt ceiling news that came out. And targeting, first target being 40.60, this low here, but then ultimate target being about 40.20. We're in about a 1.5 risk reward ratio on that one. We're holding steady, basically just seeing what happens here if we get stopped out or if we go down. And I'm going to show you the reasons why I'm in this short. First reason being the dollar. Every single time we get positivity on the dollar ripping up, it's inverse of the S&P 500. We start to see some weakness on NASDAQ and S&P 500. We haven't seen this yet. It's been a delayed reaction. February made a low. We pushed up on the dollar. S&P 500 sold off right there. Same idea, we made a low on the dollar. We've been pushing up. S&P 500 from that low has also been pushing up. We're looking for a delayed reaction and a sell-off. Here's another time where the dollar bottomed. We had the August high. Dollar bottomed, pushed up, and S&P 500 also pushed up with it. You see here, orange line is the dollar. We pushed up, and then green bars here, S&P 500 pushing up. Delayed reaction, then we end up selling off. Another time here at the end of May 2022, dollar bottomed, pushed up. S&P 500 also bottomed here, pushed up with it. Delayed reaction, then we had the sell-off. Here's another time, dollar bottomed, S&P 500 went sideways, kind of up. So dollar's pushing up, S&P 500's trying to go up, actually makes a new high, even though dollar's ripping higher. Then boom, sell-off comes. So as you can see, every time the dollar gets a push up, there can be a delayed reaction where S&P 500 falls after it. Another reason is the put to call ratio. So every time the put to call ratio goes extremely low, it's kind of a contrary indicator. A lot of times, obviously, when there's less puts than calls, there's more bullish pressure on the market. But when we get to extremes, where we get to really low levels of the put to call ratio, it means that everyone is on the long side, and there's typically a rug pull operation that happens in the opposite direction because no one has any downside protection. So we get a fast drop to stop out a lot of longs, only at real extremes of the put to call ratio. So an example is last time we got really low is February 2nd here. So there's an extreme low. February 2nd was the top on S&P 500. So as you can see, put to call ratio is extremely low. Right now we got 2 days really low. However, one thing I don't like is we got a big push up in the put to call ratio. It's still low. One thing I don't like is we got a big push up yesterday in the put to call ratio. When we get a fast rise, it means that we could actually go up in the market to stop out those people who rush to get puts. And you'll see that in other times, like if we take a look at Wednesday, April 26th, I'm sure that was near a bottom and we got to bounce the next day. So let's look at February 2nd, let's look at April 26th. February 2nd was the high, we sold off because put to call ratio was extremely low. And then April 26th, the put to call ratio rose. Yeah, so April 26th was near bottom. So the put to call ratio was very, very high on that day at the end of April 26th. So we got pushed up. So again, basically what this tells me is we could have a bounce today, Thursday. Ideally, since I have a short bias, I would like the bounce to be capped at about 42.15, maybe 42.20 on ES. Basically pointing to about 420 on SPY. I'd like it to be capped around there, just above 420, maybe 420.50, and then continue lower in the next 2 weeks. So personally, based on that, I would like to see something like this. And then we go and we target these recent lows. Here's the 5-day rolling average of the put to call ratio. You can see that we're extremely low. We got this little tick up as we saw, I just pointed to on the other chart. Little tick up in put to call ratio, but very historically low. And every time we are down at these 0.8 levels, that's when tops occur. But based on this, it shows that there's a little more room to go. So maybe after today, we squeeze shorts out and this drops down to below 0.8. Then we start to get our fast sell-off in the coming 2 weeks. But this is, again, something I'm paying attention to. I've said this in previous videos. When the put to call ratio is down at these 0.8 levels, it's not a time you want to look for longs. But when we get to above 1, when we get to 1.1 especially, definitely time to look for longs. Now let's take a look at NYA. NYA is the entire stock market, an NYSE composite index. I like to overlay this over the S&P 500 because it shows an extreme divergence. Here's NYA overlaid with the S&P 500. You can see this extreme divergence where ever since about April 14th, NYA has been going lower. It actually goes even farther back. If you go back to February 2nd, ever since February 2nd, we've been going a lot lower and we've been selling off. Then this time we've been going lower and we've been going up on the S&P 500. So that's a divergence. If we bring it to the weekly chart, it's very clear to see this divergence. So you'll see this is ever since the all-time high. You can see we had a divergence here before the 12% sell-off. You see that we made lower highs on NYA, we made higher highs on S&P 500, and that marked a top and a 12% decline that happened very rapidly. Another time here was when we went lower from the March high to the August high. NYA was lower, S&P 500 though went higher. Another divergence. What happened? We had about a 10% sell-off in a few weeks, and now we have it again where February 2nd we went higher on S&P 500 to today, but on NYA we have gone lower. So again, we could have a nice 9% sell-off in a few weeks. That would bring us down to about 3,900 on S&P 500 in a matter of a few weeks from right now. But the divergence is still extended. Divergence could go on for a long time, so we're kind of just patiently waiting for this to play out. And that's another warning sign why it's just not good to look for longs, in my opinion, based on these things. Here's RSP overlaid. So now the orange line is RSP, as you see right there. RSP is the equal weight. That means that if every single stock was weighted the same in the S&P 500, this is where we would be, which basically means there's just like 5 stocks holding up the market, the big ones like Apple, Nvidia, and so on, so forth. So it means that the rest of the stocks are really weak. And when that happens, it just means that there's a high probability for a sell-off because only a few stocks are participating in the rally and there's not enough money to push up all the stocks. So once this gets fully exhausted, then we have a rapid fall. We're going down on RSP, but on S&P 500, we've been going higher. So you can clearly see this divergence that's happening right there. Now let's take a look at the last time we had this divergence where S&P 500 has been going higher while RSP has been going lower. You can see all throughout 2020, we didn't have any of those, or 2021, we didn't have any of these divergences. None of them these past years here. None of them, no divergences. One almost happened right here where S&P 500 went higher, but also RSP did go higher. So we didn't even have it there, so we can't even look at that time. So it's an extremely rare signal when this does happen. You can see again, we almost had it in 2015. We went higher on RSP, and we went slightly higher in S&P 500, and then we sold off. Again, didn't quite get the signal there. So again, this doesn't go, we can't find it any of these years. We actually have to go all the way back. And the only time we had the signal was actually 2007. So right here is the last time we had this signal. You see RSP made a high here. We made a lower high. You see S&P 500. We made a high. We made it a higher high. Then just look to the right and see what happened. So this is the last time we had a divergence between RSP and SPX, the 2007 crash. We fell from high to low, 58%, but that took a year to play out. That took over a year to play out. So this isn't a short-term signal. This is a signal that could show weakness for the coming year. But if you're looking to buy puts that expire in 1 month, maybe 2 months, again, maybe you won't get that big of a drop. You can see here, once the divergence did actually end up topping, we did get a quick 5% sell-off in 2 weeks. And that's what I'm looking for. I'm looking for a 5% sell-off in 2 weeks, which basically points to from ES going from 4,200 to 4,000 in 2 weeks, basically by June 15th, seeing that 4,000 ES and seeing that 400 SPY by about June 15th. That's basically what I'm looking at. But again, it's just not a reason to look for longs. I'm sorry. It's just so hard for me to go long when I see this. The last thing I wanted to take a look at was the VIX. So now I have the VIX overlaid on the weekly chart with SPX, and here is a significant weekly VIX divergence. As you can see, there's 3 touches. So we have 1 low, we have 2 lows, now we have 3 lows. So these are 3 higher lows. And on S&P 500, this same week, this was a new high. Then we had a higher high, and then we had a higher high to start the week. So basically right now we have 3 higher lows on the VIX, and we have 3 higher highs on the S&P 500. Every time this has happened, there has been a minimum 4% sell-off within 2 weeks of the high, but typically average about 5 to 6% sell-off. And again, this points to about 4,000 ES by mid-June and 400 SPY by mid-June. I'll show some more examples. Here are a bunch of VIX examples right here. June 16th, I'm expecting about 402 SPY, about 40-30 on ES because of the reasons I just showed. Here, same idea, where VIX slightly made a higher low, and we made a higher high on SP 500. We sold off 5.6% in 3 weeks. Last time here was end of 2021. We had the all-time high. Here is one low on the VIX. Then here is a second higher low on the VIX, and then here is a third higher low on the VIX. So if you go look at SP 500, we had one high, we had another new high, and then here we had another new high. So 3 higher highs, just like the same setup we have right now. We had a 5% sell-off in 3 weeks, and then we had an 8.7% sell-off in 4 weeks. Another one, there's 2 touches. We had a low on the VIX, a higher low on the VIX. We had a high on SP 500, another higher high on SP 500, 5% sell-off in 3 weeks. Here again, we had a low on the VIX, a higher low on the VIX. We had a high on SP 500, a higher high on SP 500. We fell 4.3% in 1 week. Here's another example that actually got drawn out pretty long. It was 3 weekly higher highs on S&P 500. Again, 3 weekly higher lows on VIX. We had the low here. This was a higher low and then another higher low. We had a high on S&P 500, a higher high right here on S&P 500, and then another higher high. After that, we sold off 15% in 2 weeks. That was the COVID crash. This is the last VIX example I'm going to go over. There's a lot of them. You can go take a look at these divergences on your own chart. But again, we had a low in the VIX, a higher low, another higher low. We had a high in S&P 500, a higher high, and another higher high. After that, 8.6% sell-off came in 2 weeks. So these are all the reasons why I find it extremely challenging to look for longs, because we do have these divergences going, and I am waiting until they play out to flip to the long side. So personally, I cannot look for longs until we do get down, at least sweeping these recent lows at 40.60 to 40.50. Then I can start to look for longs at about 40.50 on ES or about 403 on SPY. But until then, I'm going to be holding my short unless I either get stopped out by a new high or we get to that target. That's going to conclude this video. Thanks so much for watching. Give this video a thumbs up if you appreciate it. I really do appreciate all your support on this channel. Let me know in the comments down below what you want to see more of. Look out for the next video coming out Sunday at 12 p.m. Have a great day trading. Have a great weekend. And I'll see you in the next video.